Hello everyone, my name's John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are covering hypothetical computer-simulated trades. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. So if this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Lock in Your Success LLC, which we can found at lockinyoursuccess.com. That's L-O-C-K-E inyoursuccess.com. And here at lockinyoursuccess.com, myself and my mentors are here to help you win in trading and in life as well. So today, I'm here to talk to you about high probability options trading, also known as income trading. This is where we utilize option strategies to make money from the passage of time rather than depending solely on price movement alone in order to make money. Meaning we can often make money whether the market goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does give us a much better probability of winning more often than not. So today I'd like to talk to you about a strategy called the Super Bowl. Now this one's a little bit different than we show in a lot of our other strategies. Our other strategies are technically higher probability than what the Super Bowl is, and our other strategies tend to rely more on time decay, where the Super Bowl relies a little bit more on price movement. But as you'll see, the Super Bowl is really a fantastic, excellent performing strategy. Now the Super Bowl is a strategy that we can do on the SPX or the Russell 2000 index using their options, of course, because the index themselves are not tradable. The strategy requires a minimum of somewhere between $1,000 to $1,200 to initiate. It has a profit target of approximately 100%, and it has a maximum loss of approximately 100%. And the size that we're going to demonstrate this strategy is going to be $1,000 planned capital, meaning that we may lose approximately $1,000 if we take a loss, and we could make up to $1,000 if we have a win. Now, this is what we call an all or nothing strategy. In other words, you are going to win or you're going to lose, and if you do lose, you could lose your entire investment. So you want to make sure you position size this type of trade appropriately for your account. In our demonstrations, we're going to be using 1/10 of our account size for this type of strategy, which generally works out pretty well. So a little background on the Super Bowl. The Super Bowl is a strategy that I designed at our Trader Transformation Workshop that we had in 2019. During that workshop, we gave the group of traders that we were teaching the task of coming up with a trading strategy that won in 2018. And if you remember, 2018, a lot of our market neutral income strategies had a bit of a hard time, as well as a lot of market neutral traders, because we had 2 market crashes during that year and we had some very unusual implied volatility skills. So we wanted to show them that they could come up with a strategy that would make money. And one of the strategies that I came up for demonstration purposes for this workshop was the Super Bowl. Not only was the Super Bowl super simple, but it also back tested extremely well, and since then it's performing extremely, extremely well in the market environment from 2019 forward. So the Super Bowl is a bullish vertical spread, and I'll show you a couple of examples of the strategy. That's entered when the monthly cycle is 65 days to expiration. Can you use weeklies? Of course, it doesn't really matter. But for the purposes of demonstration, we're going to stick with the monthlies. And when we do this, we're going to enter a bullish call vertical in a manner where the total potential profit and a total loss are approximately the same. They're about equal. Now, there are some variations to this in the full guidelines, but that's the general concept. From there, we do nothing until the next monthly cycle is 65 days to expiration. So this is one of those strategies. You enter it, there's no adjustments, there's no need to worry about the risk in the trade because the total, you're willing to lose the total risk in the trade, so you're not worried about market crashes or anything like that. The only thing a market crash might do is cause you to experience a normal loss within the strategy. And that being the case, we're not particularly concerned about a market crash or even a really big down move. So we do nothing during that time period. And when our next monthly cycle is 65 days to expiration, what we're going to do is we're going to enter the next trade, what we call trade 2. At that time, we're going to check on the original trade and see if that trade is up money or down money. If the trade is up money, we're simply going to exit it. If it's down money, we're simply going to wait and monitor that trade on a day-to-day basis. And if that trade is profitable at all, we're simply going to exit it. And if that trade is down money, we're going to stay in the trade until it expires, in which case we may end up expiring at a total loss or somewhere in between a total loss and a gain. And that's it. It's really that simple. So let's talk a little bit more about the performance history. So these are the statistics of the trade for as far back as we can backtest in the ONE software. This was backtested all the way back to 2003 in the OptionView software with similar results. But our ONE software only goes back to 2011 expiration cycle. So this goes back from January expiration 2011 all the way to the most current trade, which equals 124 trades. Now, during this period, we had 87% winners. Now, an 87% win rate is extremely high, even for a trade that theoretically has a 90-95% probability of winning. You're going to find that this trading strategy actually has a theoretical probability of winning somewhere, I think, in the 30% range, but the actual probability of winning based on history is about 87%. During this time, we had a total trade for trade return of 2,851%. With our 87% win rate, we had a maximum consecutive wins of 31 wins in a row. That's 31 months in a row, and a maximum consecutive losses of 3 months in a row. And I love all those characteristics about the trade. Some of the characteristics I don't like so much is that our average loss is 2.7 times our average gain. That's generally a bit of a warning sign at times. And the other thing that I actually do like, but I want to warn you about, is the trade size must be small relative to some of the other types of trades we do. So some of the other strategies, we might put close to 100% of our trading account into that strategy. In this one here, since our loss is a total loss, we want to make sure we limit that size to a maximum of 1/10 of our account size. And the reason we do that is to maintain a reasonable risk management. So as you can see, we have fantastic historical statistics on the trade. So a question that often comes up is, well, how did it do in 2020? Because 2020 was a very volatile year where, again, neutral strategies might tend to have a problem because of the extent of price movement. So let's take a look. So in 2020, the Super Bowl, as demonstrated on our Monday morning options trading for income webinars, returned a total of 300.6%. And that came from 10 wins, 1 loss, and we had 1 break even. So if we look at a month-to-month results, we had a 57.3% return in January, 59.1% February, 51.1% in March. Again, these are expiration cycles, so there's a little delay. In April, we had our Corona crash, so to speak, and the market didn't recover before the expirations of our options, so we lost what we call 107.1%. Now, the reason we lost over 100%, I will explain when we show the trade setup. In May, we made 15.1%, June 13, July 56.6, August 27.6, September 47.1, October was a break-even cycle. Our November was 27.6, and our December was 51.1% for a total return of 300.6%. Absolutely fantastic. However, one of the things I like to do with this strategy is equalize the returns for a size relative to account based on the size we would trade our other trading strategies. So if you remember early on, we talked about trading this 1/10 of your account size, meaning that what we're going to do here is divide our 300% gain by 10, and that should result in a 30.06% return if you wanted to compare that to the other strategies such as an M3 or a standard bull trade. So let's take a look at the trade setup. What I'm going to do here is I'm going to go over 3 trade cycles for you. I'm going to go over our December 2020, our January 2021, and our February 2021. And I can do this because the trade's so simple. You're basically entering and exiting. You're not doing a whole lot more. And this is going to give you a good sampling of how the trade does and how it performs. So this is October 14th, 2020. The asset price on the Russell 2000 is almost 3,500. It's 34.9942. What we're going to do is we're going to buy a bullish call vertical. And we're going to do it so that, or ideally we'd like to do it so that our gains here, or how much our potential profit is the same as our potential loss. Now in this case, you'll notice that's not the same. And for those of you who haven't seen this software before, it's an analytical software called OptionNet Explorer. And what it does is we have our call options here on the top, we have our put options on the bottom. These are the strike levels. What we're doing is we're buying a 3,500 call, we're selling a 3,520 call. That's going to give us a position that looks like this on an analytical graph. The analytical graph has the asset price across the bottom. So the current asset price is 34.9942. This is 34.9942, and this up the right side here is our profit and loss in dollars. The blue line here is our expiration line. It shows us the value of our position should we let it go into expiration at any given price point. And the curved line that goes from red to blue to green is our T+0 line, which shows us the profit and loss as of today and the projected profit and loss of the position at any given price point of the Russell should it go there today. So here you'll notice we have a maximum profit of about $850 and we have a maximum loss of about $1150. This is unusual, and we have an unusual implied volatility skew curve environment where we can't get the profit and loss we want within the range. And the way this is set up is explained within the rules. But under these conditions, normally we'd like to see a $1,000 potential gain for a $1,000 potential loss. We're calling the planned capital in this trade $1,000, even though we currently have over that in it, and that's because the normal trade setup will allow us to do it for $1,000 or less. It just depends on the environment. So we're going to call our planned capital $1,000, meaning that if we lose this trade, we may lose more than 100%. It may be 112% or something like that. Our potential gain on this particular trade is going to be $950. Notice we are 65 days to expiration. This is when the trade's entered. There is no technical analysis. There are no triggers. Not that you can't do that. You could certainly use a strategy like this with technical triggers. In fact, yesterday, during the day, I did one of these trades on a short-term basis. So yesterday, and today is, by the way, it's February 24th, but yesterday on February 23rd, early in the morning, the market was down a lot. As a matter of fact, the SPX, I think, was down 70 points at one point. And even though the market was down early in the day, I was overall bullish for the next week or so. In other words, it was coming down to a support point. I thought it was going to bounce. I did one of these super bulls on a weekly strategy when the market was really far down, and by the end of the day I was up a substantial amount of money. And then as of today, we got another up move in the SPX, and now I'm 3/4 of the way to full profit on it. So I may end up closing a little bit early, but that's just an example of how you can use this for our shorter term trades and stuff. But as you see from the results that we showed you, even non-subjectively and not paying attention to anything as far from a technical standpoint, this strategy still has performed extremely, extremely well. So anyway, this is a strategy here. We're 65 days to expiration in December. Our exit date on this, if it's profitable, is going to be when January hits 65 days to expiration. If it's not profitable when January hits 65 days to expiration, we just stay in it and see if the market comes up and allows us to be profitable in the position. If so, we're just going to close it, and then we'll just stick with our January. So let's do this. I enter the position. I do nothing until January is 65 days to expiration. That's literally like 28 days. So I do nothing for 28 days, meaning I don't have to monitor the market. And that's what I love about this, the simplicity, the lack of maintenance. I don't have to worry about a down move because if I lose, I'm planning on losing my, in this case, about 1150 anyway. So we just keep this going. But during this, one of the things I want to show you is, let's see, I want to go to October 30th. This is what happened early in the trade. I go to October 30th. You can see we're getting hammered. If we take a look at the price chart, we entered when the market was up here somewhere, and now the market's all the way down to what, 32.41. Now, one of the challenges that a normal bull trade has is that we have $27,500 in risk. If you don't know what a normal bull trade is, look at the previous episode of the winning trade. We did an episode on the bull. But a normal bull has a risk of $27,500, and you could possibly make $2,500 if things go well. So when you have a risk of $27,500 and you have only a capability of making 2,500, you don't want to let the drawdown of that strategy get too much past $2,500, because if you do, it throws the numbers off completely. You know, in other words, if you lost $27,500, it would take you, I don't know how many months of full profits to make that back. It makes the strategy not viable. So that being the case, you have to be, if you're in that strategy, you have to worry about a down move. If you get a big down move, you have to get out. If you get a drawdown, you have to get out. This one here is a different story. Since this is capable of making $1,000 in a single month, if I lose $1,000 in a single month, or even 1,200 in this case, or 1,150, it's not that big a deal. It's just a normal business as usual, so to speak, as far as a loss goes. So I don't really have to worry about this. I don't even have to look at it. But that's the difference, right? So in the normal bull trade, and by the way, the regular bull trade lost this cycle, and the reason it lost this cycle is because the market went down and I had to stop out. But it lost the cycle, even though had I stayed in the trade and been irresponsible with my risk, it would have come back and been profitable. Now that's going to do two things, right? It's going to number one, is going to, if I did stay in it and I did win, it's going to promote bad habits for me. That means I'm more likely to do that again, and at some point I'm going to realize that huge risk and it'll be a problem. This strategy is not a problem, because the risk isn't a problem. I have a very distinct limit as to what I can possibly lose in the trade, and that limit is very reasonable compared to what I can possibly make. So not a problem here. We're good to go. So we just wait it out. And I'm going to pop ahead until January is 65 days to expiration. Right? We got our pullback, and now we get our reversal, which the market's been doing quite regularly. And let me just go to 65 days to expiration for January, which is going to be actually right here. So here we are. We entered the trade, what, 28 days ago or so, and we've done nothing. Now we come and we missed that whole drama scenario that a lot of traders are dealing with. Oh my goodness, the market's pulling back, my trade's drawing down money, I have to adjust, I have to do this. We missed that whole scenario, right? No stress, whatever. I come back here 65 days. Oh, look, my trade's up money. It's time to enter my January cycle. I'm simply going to exit the trade. And we come in here and we close this trade for a profit of $221. Or if I'm using that off my planned capital of 1,000, that's going to be a profit of 22.1%, right? If I figure that out. And from there, I'm going to enter my January Super Bowl. So my January Super Bowl, I'm kind of experiencing the same problem. I am entering a bullish vertical. The asset price is at 35.64. I only want to go so much higher than 35.60 for my long strike. In other words, if I went high enough, I might be able to get my 1-to-1, but I want to restrict how high I go because that really starts killing my probabilities of actually winning this thing. So, I'll go 10, 15 points, and this is what we have here. If we do that, we can put our long at 35.80. We put our short at 3,600. We end up with about a $900 potential gain for an $1,100 potential loss. And we do the same thing. We enter the strategy and we wait. We let this thing go until our February options are 65 days to expiration. During that time, right, we actually had an uptrend. When we have an uptrend, this strategy works fantastically well. We don't even get drawdowns. And we end up being up $513 when February is 65 days to expiration. Therefore, we simply close the trade at our profit, which after commissions is going to run about $511 profit, or 51.1% of our planned capital. And we're going to do the same thing in February. We're going to enter the trade. We're going to try to get a 1-to-1 risk reward if we can, but we're watching how far above the money we go. In this case, we have a 37.10 asset price. I went almost 20 points above the market to 37.30. And this is what we got for a risk-reward ratio. This is the trade. And then again, going forward, we don't do anything until our, in this case, March expiration is 65 days to expiration, which is going to be approximately 28 days. And we're going to sit in this and see what happens. So let's just pop ahead until, actually, did we get any down moves? But let's pop ahead till January 13th. We'll ignore our trades. Now March is 65 days to expiration. Notice we did get a big down move here this particular month, which again may have stopped out other trades that were bullish of nature. It may have created a situation where you had to adjust down and then chase the market on the way up on some of our more market neutral strategies. This one here, we did nothing. Here we are. We are, again, time to take a look at entering our March. If we're profitable in our February, when we enter our March, then we're going to exit. This case here, if I close this trade, this is up $361 or 36.1%. We're going to close that and simply open our March position, which, by the way, was also a winning trade, but I'll save that one for another episode. So that is 3 examples of our winning trade. Now, a lot of people will say, well, geez, this is not actually an income trade, and I agree with you to the extent that this strategy is not positive theta when it starts out, but it is affected by theta. So in other words, this T+0 line is going to shift as time goes by. But I also like to point out, when we take a look at our results, what we find is our actual historic results is we win 80%, 7% of the time, or we have won 80%, 7% of the time from the time period of 2011 to 2021. That's 2 years. I'm sorry, that's 10 years. And like I said, I've actually done this since 2002, and that's literally 19 years, and we have a similar win rate. So the actual probability is much higher than our statistical probability. And I would also argue that a lot of strategies that have a statistical probability of, say, 90% actually win closer to around 70 to 75% of the time. So it's a very, very interesting thing to think about when you're choosing your trading strategies. Now, before you go, I want to share with you a special treat that we're offering on Monday, March 1st. We're allowing free access to our Options Trading for Income webinar on Monday morning, March 1st, as well as access to the recording for a limited time. Now, to get that, simply go to our website at lockinyoursuccess.com. That's LOCKE in yoursuccess.com, and you should get a pop-up that's going to allow you to click on a link that will allow you to register for that special session. This is a fantastic opportunity to see the current state of all the open trades we have, and you can see that real time. So I encourage you to do that. Simply go to our website, lockinyoursuccess.com. That's LOCKE in yoursuccess.com, and you should get a pop-up with a link that you can use to register for this free special event. And if you can't make the event, I think we're going to have the recording up for, I believe, 24 hours. So you'll be able to watch that recording while it is available. So make sure you take advantage of this special offer. Make sure to check out our free Trading Performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions or comments or anything else you'd like to see on the next winning trade, please simply comment on this video and I'll make sure I answer those questions for you. Until then, thank you, and we'll see you on the next winning trade.